Hello and welcome to the latest episode of Damien's Midweek Markets, the show where I talk about what's happening in investment markets and what to look out for in the days and weeks ahead. Now, it's been an interesting week in investment markets. If you go back to last week's show, I focused on breakouts and I looked at a number of assets, in particular commodities, the pound, and talked about them attempting to break out. And in fact, I even mentioned a couple of numbers and levels to keep an eye on. Now, if we focus on gold to start this week's show, gold did break out above that 1850 level, and I said it could push on towards 2000, and in fact it did attempt to do that this week, and we've now hit some new highs on the price of gold, and there's a flood of money going into the precious metal, and that's because of two reasons really. There is a fear around the coronavirus, a second wave across the world, and in particularly in America, but also because of monetary policy. And that's, again, particularly in the US, with the US Federal Reserve meeting this week, in fact, which is one of the key events to keep an eye on today, to announce their latest monetary policy decision. Now, nobody's expecting anything to change. In fact, they're expecting the Federal Reserve to flag up that interest rates will stay lower for longer, and whether there is even more QE, we'll have to wait and see. But the point is the printing presses, the money printing, is still going at a rate of knots. And of course, that devalues your currency. And in this case, we're talking about the dollar. And if the dollar is devaluing, and if you look at the dollar index, if you Google the Bloomberg dollar index, you can see how much it's fallen in the last couple of months. And of course, the dollar is a key currency. It's a key asset actually for a lot of investment markets. It has a huge impact on what goes on in equities, in other currencies, but also in commodities. So because gold is priced in dollars, that means that when the price or when the value of the dollar falls, then it means that gold becomes particularly attractive to overseas investors. The upshot is that a falling dollar is good for commodities like gold, like silver, and of course like oil. Now, we've seen the gold price rally 25% year to date. That's an incredible run. And the next question obviously becomes, where next? Will it get to 2000? Now, I think most analysts expect the gold price to get to $2,000 per ounce. But what happens after that, we'll have to wait and see. Gold does look quite overbought at the moment, so do expect some kind of pullback. But if you look at the price of gold and adjust it for inflation over the long term, then you could argue that the high should really be around $2,500 per ounce, which means that the gold price could have some more space to run higher. But we'll have to wait and see. But certainly the environment at the moment is very good for gold. And if you've got any in your portfolio, like I have in my 50k portfolio that I run on 80/20 Investor, it's been a fantastic diversifier. Now, if we look at the bond market, the 10-year gilt yield has continued to fall. Now, this week we actually hit an all-time low of 0.1% on the 10-year UK gilt, which is an incredible statistic when you look at it. And that, again, is because of the concerns around the coronavirus, the second wave. But don't forget, in the UK, we also have Brexit lurking in the background. So it means there's a lot of angst around the outlook for the UK economy. And if you have a lot of nerves around the outlook for the economy, particularly in the UK economy, then that means that UK gilts tend to do well and people buy them. They seek those havens. In the US, the 10-year Treasury yield has fallen to 0.58%, which is a 3-month low. And again, that's because of concerns around the economic outlook in America, largely because of the pandemic. But the haven bids are in direct conflict with what the equity markets are saying. So we've got, on the one hand, bond markets are suggesting that the outlook is poor and people are nervous. But then if you look at equity markets, they're quite buoyant, particularly in the US. So a lot of that is all down to monetary policy as well, as I previously mentioned. Now, if we look at currency markets, I mentioned last week to keep an eye on the pound-dollar exchange rate, and in particular, keep an eye on the pound breaking above the $1.27 level. And I said if we continue to push above that level, then we were likely to head towards a $1.30. And in fact, that is what's happened. As I make this show, I'm looking now, we're looking like we're just about to touch a bit above the $1.30 level. So if we do break above that and close, then we could see more strength in the pound. And this is largely being driven by dollar weakness more than anything else, not anything to do with the pound necessarily being strengthened because of any positive news relating to the UK. It's down to the dollar weakening. The dollar is almost a crowded trade now, with people betting on it devaluing, and largely because of monetary policy. And in this week's 80/20 newsletter, I'm going to talk about the importance of the dollar to markets right now. And if we get a change in direction, so let's say the dollar suddenly strengthened, why and how it could pull the rug from under numerous investment markets, including commodities, bonds, and equities. If we jump to equity markets now, the S&P 500 is still in that box between 3,250 and down towards around 3,000. So we broke above that, and then we've pulled back inside that box again. The FTSE 100 is now around about 6,138. So we've pulled back again on that. The FTSE 100 is struggling because of the strength of the pound. If you remember last week, I mentioned that inverse correlation that exists between the strength of the pound and the FTSE 100. So we've seen it lag this week. So it'll be interesting to see what happens in the coming days and weeks ahead. Now, over the last 2 weeks, cyclical sectors have outperformed growth sectors. So cyclical sectors such as financials have done much better. And we've seen that rotation I mentioned last week, and it meant that we saw rotations out of tech stocks into these cyclical sectors. And that is going to be something to keep an eye on, because we've had those rotations suddenly swing back and forth. We've had tech stocks sell off massively on a given day, down as much as 5, almost 9% in the case of Tesla, to then rebound the next day. Now, last week on 80/20 Investor, I mentioned the Nasdaq 100, which is a tech-heavy index in the US. And if you look at that on your app on your phone, so if you call it up and you look for the Nasdaq 100, you can see that almost vertical line that's come from the March lows, where the market keeps pushing high, it pulls back, but then bounces off, almost an imaginary line there, the support line. Now that support line, if it breaks, and it's been tested a couple of times in the last sort of week or two, if that breaks, then that could be a bad sign for tech stocks, but also the wider indices, because tech stocks, the big tech stocks, things like Facebook, Apple, Amazon, they have an oversized impact on equity markets and the wider equity indices such as the S&P 500 in the US. So we want to keep an eye on them. And of course, last week I mentioned about tech earnings. We're getting into the real meaty part of earnings season now. And this week we've got Amazon, we've got Facebook, we've got Apple, and we've got Google all announcing their earnings. So that's today and tomorrow. In fact, I mentioned last week that Amazon were due to announced their earnings last week. I got that wrong. It's actually this week, which doubles down on how important this week in terms of earnings is going to be. Now, what happens in those tech earnings and then to the stock prices afterwards could have a big say on the wider indices in America and therefore in the rest of the world, given their importance and size. And last week we had Tesla announce their earnings, which were largely greeted positively, but also Microsoft. And despite Microsoft beating analyst expectation, their share price plummeted. So it's a bit of a bad omen for this week that perhaps, despite what the tech companies might announce, could the market be disappointed? So it'd be interesting to see what happens to tech stocks, the share prices in the next 2 days when those big companies announce their earnings. So to sum up, keep an eye on the Fed decision that we're going to get later today, because that could cause a wobble in markets, although it's not really expected to, because the Fed aren't expected to say anything drastic. Keep an eye on those tech stocks in the next sort of 48 hours. What happens? That's Facebook, Amazon, Apple, and of course Google, who are known as Alphabet. The parent company is called Alphabet. And keep an eye on those coronavirus headlines that we're seeing around the world about the potential second waves, because that could start to have a huge impact on particular sectors, including the cyclicals, including airline stocks, if we get more quarantine measures put in place. So that is it for this week on Damien's Midweek Markets. As ever, you can contact me via email, damien@moneytothemasses.com, via Twitter, moneytothemasses is the Twitter handle. We're on Instagram. Of course, subscribe to our YouTube channel, and you can join our Facebook community group at facebook.com/groups forward slash money to the masses.